Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. World on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you guys buy it. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Put it back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. So we got non-farms payroll today, and this one I think, fix the camera here first, real quick. I think there's some real possibility that this number could disappoint. At least that's kind of the whispers, is that the number could actually be negative. But either way, I think that this is a number that has a high potential to surprise the market, and we should leave that in Discord. Right. So let's come over to the charts. Treasuries here. We did end up getting that further move down that we were looking for. It didn't really happen until after the stream. But since then, it's been mostly flat here in the Treasuries. S&P 500 had an okay day yesterday. I'd say they recovered that quite well, although we're not quite to, some of these June levels. Oil, able to recover the $100 mark, but they've got a long ways to go, right? They're going to recover back up to like 110. So natural gas also having a little spike yesterday. Gold and silver, well, they got hammered this week, and now they're just kind of sitting down there. Copper recovering. Copper's still looking, I'd like to see a stronger bounce, but you ain't got Bitcoin. They're trying to pull something out. But we'll see. This non-farms ends up being like good, then man, all of these things are going to get hammered, because that means higher interest rates again. And we got the dollar. The dollar having a spike overnight, going all the way up to 107.4 at one point. So that's pretty wild stuff. All right, so coming back over here, the news that we got here, we're going to have U.S. non-farms payrolls. The consensus I got here is 268. I actually think it's probably closer to 220 is kind of the analysts I've been looking at. But again, there is actually, because of like seasonal revisions and things like that, there is a possibility that headline number comes out negative. Also, because of all of that, I think things like the unemployment rate, we're expecting 3.6, and the average hourly earnings month over month, which we're expecting to be spot 3, could be more significant than they normally are. All right. So let's see here. Got to make sure I got my news squawks and everything up here. And then I'm going to switch over to my kind of pared down workspace. Good morning, Octavius. Okay. I think we're good to go there. And then we are going to have to execute on the 10-year. Now, on this initial news is probably going to be pretty wild. So I'm probably not going to be able to trade the actual news here in micros. In this kind of a situation, it's probably going to be a little too crazy. So I think I'm going to keep the safety on here and see what happens. We got about 2 minutes here. You know what? While that's going on, I probably could. Take a look at something here real quick. Cool. All right. Do this. Okay, so remember 220 is the number we're listening for. Okay. Ooh, it's a big beat. That's a big beat. This is gonna get creamed. Look at this. Man. That is, oh man. So the whisper was that because of seasonal revisions that this number could be less than anticipated, but it was we were looking for like 220, 250 and we got 300. So it was a pretty good beat. I expect treasuries are going to get hammered here. The S&P 500 is falling here. Good numbers for ES. Well, it's kind of one of those good news is bad sort of situations, right? This suggests that the Federal Reserve's attempts to control inflation and slow the economy are not having any impact at all yet, and that they will have to raise interest rates significantly further in order to slow down this overheating economy. Now, we need to read in here. Unemployment rate was 3.6 as expected. And what was the hourly earnings was in line. So everything else was in line. The headline number, though, being 300,000 is a big surprise for the treasury markets. And this thing is running. Who man? So like the thing is that there's all this concern about us going into a recession. Remember when treasuries were like heading towards 3.5, 3.75, And then it was like, oh, but there might be a recession, and they came all the way back down below 3. And now with that piece of news, that's a really good reason for them to move all the way back to 3.5. And I mean, especially since the concern with the inflation numbers, I highly doubt that the inflation numbers are going to be like significantly lower than anticipated, right? So they're either going to be on par or higher than anticipated. So I think that sets us up for a pretty good swing here in the treasuries. Like, this is a sell all the things for sure. I'm really surprised. Like, I really thought that I was going to come in here and I was going to be like maybe buying treasuries and like retracing all of this week's move because the number was negative or something. And nope, not. It was a complete head fake. Well, listen, analysts' predictions on these sorts of things are very, very often wrong, right? And especially in this situation, we just have a market that, it's very difficult to interpret the data, let alone predict it. What do you do with that move? You sell something. I am long rates here, right? I'm short treasuries, long rates. That's just a no-brainer. That was just like, okay, somebody's gonna offer out for me. I'm gonna hit it. It's going pretty good so far. Although you gotta be careful on this one, right? Like there's gonna be like really steep pullbacks and stuff on it. So they did find a little bit of a pivot area at 22.5, but like we're still within the 5-minute window. So, and liquidity in the treasury is just terrible at the moment, and I'm a little worried that might just continue through all day. Like, I don't know if they're gonna. Well, we'll see. I shouldn't be so pessimistic, but I'm kind of wondering here, like, having 1200s put up there, I'm not so sure we'll get that. Now for the S&P 500, I also think it's a sell, but that one I think is a lot more questionable, let's say. So in ES, there might be really steep pullbacks. They might even come back to unchanged. The degree of the move, well, it was about 20 points in the S&P 500, but relatively speaking, these days that's not that much, right? My changes to my workspace seem to have worked really well too, by the way. So happy about that. Interesting the treasuries come back that far. 10-year not coming back much at all. And significant flattening on that move too, by the way. Wow. Well, I tell you what, guys, this market never ceases to entertain, does it? Wow, you're gonna go long 23.5. I shouldn't say things like that because it's just gonna make you question the trade, right? But this is not a trade that I would. That's a pretty gutsy move, man. Like really, because I took the trade like right at the beginning before it started going. I'm probably okay here, but really trying to hold a position in this kind of action is a little difficult. Yeah, well, I mean, you are getting a little bit of upside, right? I'm wondering though if they'll be able to get through the liquidity between 26 and 28 though. There is a strong bid there at 25, which I also find very, very curious. Yeah, there is definitely somewhat of a hole at 25 half now, isn't there? The thing I would be careful with in this situation is that the liquidity is so light and the market volume is likely to be so strong that um it's really risky to try and rely on those holes in this situation because it's kind of like if you have an ATV that's going 100 miles an hour and there's a little hole there in the road. Yeah, it's going to affect the ATV, but it's going to just ramp right back out of that hole, right? Because it's going so fast. But what we could see here is, well, I don't know if often with a Friday, I'm actually kind of thinking like maybe I'll offer out and see if somebody hits me. Okay, yeah, I think there's lots more potential, but uh, for me, okay, so first of all, if I'm getting $40 to $50 on a trade, that's it's usually difficult for me to get more than that in one full swing, right? But also you get this thing where it's like they make the move and then like it doesn't move as much the rest of the day. But they might come back here on us a little bit more. I am kind of. Hmm. You know what? I think that me getting out there may have more to do with my own psychology than anything because I can just think of so many times where I felt really confident like this on a big move and it came all the way back, sort of a thing. I think treasuries would bid due to the threat of over tightening equals a recession, or what would be the dominant sentiment towards the release? No, 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 no. Well, so I think first of all, a lot of it has to do with like the current situation, like in terms of sentiment and stuff, right? Because the whole thing is that this past week, last week, it was basically like, we're going into a recession. Federal Reserve isn't going to be able to raise rates to their target rate like they thought. And, that's why interest rates were falling, as they were basically saying the Federal Reserve is going to have to back off before they get to the 3.75 that they're targeting, right? Then we got that manufacturing data, and that really flipped things around because the manufacturing data kind of says, no, like there's still inflation and stuff to worry about. Okay, cool. So now we come to this, and again, here's a non-farms. Oh, maybe the non-farms will be negative, right? It surprises to the upside. So what does that mean in terms of what the Federal Reserve is going to do? They're going to keep raising rates. They're going to in all likelihood, keep raising until they get to 3.75, right? So this downtrend that we've been having in the treasuries, extremely likely to continue here. See, now that I got out, it's coming back. It's pushing a little bit more. There would have been my $50. The 30-year just like smashed through there, man. I don't know. So often when I do this and I get out early, there's they end up being $70 winners. So but I like your thinking there, Jacob, is not like terrible. I just think that maybe you're overthinking it, right? Like the biggest thing here is that the jobs will look really good and were better than anticipated, right? And so at the moment, where the data that's coming in is not supporting very well this case that the Federal Reserve really has to tighten that the Federal Reserve has to back off, right? Now, for equities, it gets a little bit more interesting, right? Because in the short term, it's bad, right? In the short term, it's, yeah, they're going to raise rates. But then that comes back into this whole thing that's like, the faster the Federal Reserve raises rates, the faster they get to that terminal rate, the faster they can crash the market and people can buy in because they'll have to reverse, right? So they're even though the gut reaction off of this in ES has been negative, there could be a reason. There could be a scenario where we buy ES because that, and then this is kind of like bullish seasonal time period, anyways. Well, he scratched it. That wasn't a bad trade, Mr. Bond. I'm impressed with how you played that. 23.5 to 25 wouldn't have been bad. Maybe a little bit too small of a trade though, given the current volatility, right? If we had gotten like 20 to 25, that would have been like, mwah. I'm gonna be kicking myself for taking profits, man. I don't know. When I look at the tape right now, I see something like just from what I know about the current situation and everything, we should expect to see Treasuries move lower, right? But like there is a lot of backwash here. We traded 20,000 contracts short, which is a lot, right? Like maybe in the end, throughout the whole day, maybe we get 60,000 contracts short, right? That would be a big move. There's just a lot of backwash here, so I kind of think that we could have a trend day, but that it's going to be a little bit difficult here for the next like 30-45 minutes. Yeah, well, how much did I give up there? It was 7.9, so it was about $20. They're pushing those lows. It's a little tepid, but they're pushing them. And you can see the way they kind of have to sweep into it. But look, yeah, it's just every step there's going to be a huge vacuum behind it. Because I'm really dehydrated this morning. I remember being thirsty in my sleep, but my lips are all really chapped at the moment. I want to keep an eye on this here for a second. I see a question about what about the former prime minister of Japan? That whole story is just really shocking. Um, it kind of makes me wonder. In Japan, probably because of that you're not allowed to own a gun in Japan, my understanding, right? So it wouldn't surprise me that maybe their security would be a little bit lax and everything, but kind of in that situation, like there's nothing that you could have done, right? And that does kind of make me wonder what kind of an effect that will have on the international community because the big politicians and power brokers is going to scare them, right? The the 5 year here is pretty okay. Okay, actually, now that I'm out, I could try messing with them a little bit here. Hmm. No, the robot's just not interested at the moment, I guess. You've heard speculation that it could be linked to China? Well, I haven't heard much about the gunman yet, so it sounded like it was a homemade shotgun and kind of just like a freak assassination. So I don't know if that's now we gotta do some searching, huh? Wall Street stunned as June payrolls unexpectedly smash expectations. Well, I did say there when I get out, I'm betting that me feeling like I need to get out probably has more to do with me and my feelings and fears and stuff than it does the actual like if it's a good to stay on the trade and stuff. Just speculation. Yeah, well, I'd be careful about just speculation on Twitter, right? Mm-mm-mm-mm-mm. While in custody, the gunman, a former Maritime Self Defense Forces member, told police he intended to kill Abe because he was frustrated with the former premier, according to national public broadcaster NHK. The assassination is one of Japan's highest profile acts of violence since World War II and came ahead of the country's upper house election on Sunday, which the Liberal Democratic Party is expected to win. Japan is one of the world's safest countries and has the strictest gun control laws. There are still no details on the homemade shotgun and its manufacturing. I mean, it is a significant story, Jacob. It is, and I think that it's obviously. I don't think that any orders are going to come into the 10-year Treasury in the next 30 minutes because of the former Prime Minister of Japan being assassinated. But it does provide context, and it could have knockoff effects that could have consequences for the markets in the future. So it is something that we want to keep an eye on and think about. It's just like, man, it was such a left field kind of what do you say? It, it just it was so out of nowhere. It's hard to even know what to think. Are we getting a Fed speaker? Oh, you're right. Bostic is speaking. Slowdown is what we need. Still a lot of labor market momentum. Kind of interesting that we're having another pullback as he's saying this, but Look, it's almost coming back down, so almost back to where we got out. So it's gonna be one of them days. I could probably try taking it in here and trying to get another 10, 20 bucks, but I think in my current situation, it probably is better for me to either be happy with 40 bucks or really wait for an optimal entry. So far, I don't really see any order flow that kind of suggests to me that traders are reacting off of Bostic's comments. I think it's probably because what he's saying is mostly in line with what Fed speakers have been saying lately, and the new economic data ends up being way more significant. Can you believe we're all the way back to 25, back to the hull? So you really could have caught the 20 to 25, and that time they gave you a strong bid to help you make it happen too. This is kind of interesting. I don't know what to think, but when I got out, one of my thinking was, oh, I've been screwed on this before. But the other thing that I was thinking was that was so much volume. There's going to have to be some really bad vacuums up above us that's going to make this difficult to just continue trending. I don't think I've ever seen a non-farms that didn't end up doing something weird and surprising me and so forth, right? Like I can think of so many times with non-farms in particular where I took the trade and I thought, oh, this is going to trend all day, and then it completely retraced the move to my shock. And I think a lot of that has to do with that it's like going into the weekend and people take profits and stuff. So I was just looking at that negative 20K and being like, well, it's really hard for me to justify there being way more selling here in this situation, just because who is speculating in the market that hasn't already gone in, right? They're likely to get a pullback. So now we did get the pullback. Do you go short again? Because you could totally do it here. But I'm looking at the ES now. They're getting a pullback. I mean, so off of the initial news, it was basically like down 20 points, right? And then after a really short pullback, they pushed further and they went another $10. But now they've retraced that $10 or so. So the S&P 500, like this scenario where like the S&P 500 comes back to break even that I discussed, it still looks like a strong possibility here. I don't know if what I'd put the over-under odds on it actually happening are. But you can just kind of see how imbalanced this market is. Man, if the CPI is a beat is 100 basis points on the table. That's a really good question. I don't know. I kind of personally, if I was on the board, I would kind of be thinking, well, we just shocked the markets and we're going to do another 75 basis point increase. And you don't necessarily see the effects of that right away. So I don't think that, going in and doing a 75 basis point raise and then a month going by and things are still going well, that necessitates a 100 basis point hike. But you didn't say, do you think they'll do a 100 basis point hike? You said, is it on the table? I think it's on the table, yeah. I think it has to be on the table. I'm just it's really I think I have to say that I'm unsure, but I'm kind of leaning towards no that they would do that. Okay, let's see what Brannigan Barrett says here, because I think he's about to say something that um surprises me. Okay. Brannigan Barrett on Twitter, this is a Goldilocks number for risk. 75 basis points was priced and expected for the July meeting. The number reduces the likelihood of an immediate recession and increases the odds of a soft landing. Hmm. So again, I can see the argument for buying the dip in ES here. I can see the argument. I don't know if it's actually a good trade. I don't think that that's the one that I'm willing to bet my own money on. But I can see the argument for it, right? And I think that Brannigan like made a really good point there. Like 75%, 75 basis point was priced in expected for the July meeting. I think that given the other data that we saw, like the manufacturing data, that I'm probably not very likely to do a 100 basis point hike. Yeah. Isn't it fun to kind of watch me like think through things and go back and forth? But one of the things that kind of makes me um how do we say special in this kind of a situation is that my mind lacks the ability to come in and say like, this is the thing, and then ignore everything else, right? Every little thought, every little factor that comes in and comes to play will come into my mind and force my mind to play it all out, right? But as I'm sitting here and thinking about it, I really like Brannigan Barrett's comment there that this increases the odds of a soft landing. I think he's right. It seems like that even though the stock market is really reeling and that the employment situation should be getting worse or could get worse. How do we say this? There was a lot of layoffs in the tech sector, but we still added 300,000 jobs, right? So even though there was a lot of signs that said that these higher interest rates were really going to slam the economy and that we were slamming on the brakes going into a slowdown, we are now starting to discover some evidence in favor of what the Federal Reserve has been saying all along, which is that the economy is really remarkably strong and that they can handle higher interest rates. Okay, I don't think that the data that we got is so conclusive that it proves that that's going to happen or that it makes it likely that it's going to happen. But I definitely think that it's enough that it has to make some of these bears question, right? It has to make some of these bears question. And we do got to remember that, like, at least right now, we're still at an accommodative rate. I think that they still need to do another one or two hikes before we get into the territory where it would be restrictive. So, okay, so we're back to my exit again. You think he's wrong? Consumers can't handle these higher prices. Well, we would. Okay. So wait. Before I go off on a big long assumption about what you mean by that. So I agree with you. Consumers can't handle these higher prices. So what is your conclusion from that then? There's a little bit higher. Oh, 27. Now, there's still some liquidity there, right? So let's not get too excited yet. Look at there's a big order there at 31.5. I'm kind of thinking about the trade that I'm going to want to go back and watch what I did, what I said around it. Either salaries have to rise or prices have to fall. Well, I think that's the sad thing, Octavius, right? So number one, prices usually don't fall, right? Deflation is you generally you avoid inflation. Inflation can be very destructive. Okay, so the Federal Reserve's goal is not to create deflation. Rather, if their symmetric target is average 2%, they want inflation to be below 2% for a while. Is really the gist of it. Okay, so prices aren't coming back. Salaries have to rise. Well, yes, but I don't say that they have to rise. That is to say that in order for people to live, they have to rise. I mean, it could just be that everybody takes a hit in the standard of living, and there's just nothing you can do about it, right? Kind of, yeah. Higher salaries would raise prices, wage spiral, and it does kind of seem to me like that may be what's happening. Is that or rather, okay, the Federal Reserve is concerned about the prices wage spiral 100%. Okay, sure. I'm not sure that that's what's happening. That's not what I meant to say. But I am worried that what ends up happening is that people just don't get raises. Like next year, everybody's thinking, well, now that inflation was really so crazy, you really got to give me like a 5% raise. And they all just give everybody 2% again, right? And everybody generally real wages declines. That may well be the case about what happens. I don't really see any other way around it, frankly. Because yeah, we can't afford to pay all of these prices, but the companies are hurting too. I don't think that companies are looking to pay a greater percentage of their profits on employee compensation right now. So, but I don't think that any of that of what you said leads to a conclusion about whether we're going to have a recession or not, right? That's the key question here. Well, really the two key questions is, are we going to have a recession? And two, what impacts does this have on employment? And the whole thing here is that we had a 75 basis point hike last month. I don't know if the impacts of higher interest rates are so quickly that we should really be seeing it in the jobs data after a month. But that jobs data that we had is not showing what the Federal Reserve wants, right? The Federal Reserve wants that unemployment rate to go up a little bit. I know it's awful. It seems awful to be like, oh, we need more unemployment. But you got to realize that there's kind of like a natural amount of unemployment. There's a certain percentage of people that are going to be in between jobs just naturally. And when you get, too low below that, you're in an overheated economy. It you shouldn't normally be able to get, past that number. Yeah, sure. Let's do a poll. Recession. Well, I don't know if that's a good question, actually. I think that we need to do it differently, because there's a very high percentage chance that we're in a recession right now, and that we may have in the past week or two seen the bottom of that recession, right? That's a possibility. So I don't think that the question is recession, or how about this? Recession in 2023, right? Because maybe we're in a recession right now, but will we still be in a recession by 2023? Is that a more fair question? Personally, from the data that I've seen, I suspect that we are in a recession right now. It's maybe it's a teeny tiny one. Recession 2023. Yes, no. That's what I'll do. Michael, how are you? Okay, well, they're still having difficulty getting above 25. So I could maybe justify a trade getting in, but I'm still leaning towards first trade is the best trade. That doesn't mean that there's not more opportunity in it, for sure. It just kind of means that for me, if I already made my money, there might not be a whole lot of benefit to taking on risk at this particular time. Good. Well, I have mixed feelings, but I did well here today. I should be pretty proud of myself, I guess. Need to go back and watch it. That might make a good short. But I don't remember what I was saying right afterwards. This one is a kind of an interesting situation because we say it's all about being an informed trader, right? Well, the difficulty about informed trading is that as a retail trader, it can be really hard to know when you're not informed, right? So in this situation, going into the report, I was careful about it. I wasn't just gonna YOLO on the news. Waited until afterwards, and then I just kind of happened to get a good spot. I wasn't informed until after the news came out. And what I basically was able to do in that situation was I knew enough about the context and the situation and the numbers and everything to be able to quickly interpret it and get long rates before other people would, right? And there was at least $40 in it, right? So it was still informed trading. It was it's interesting how that one plays out, right? But in the end, it's a really good trade. Right. And there's a lot of other things that worked out about that, because liquidity in the 10-year isn't always so great, but it was there. We were able to take the hit. It never went against us. There's a lot of things that are really good about that trade. Oh, man. I think that, I was saying I felt a little dehydrated overnight. I still feel like my mouth is dry and maybe I drink too much. I don't know. All of a sudden I don't feel very good. I could be experiencing I didn't have a super huge dinner last night, so sometimes when the food hits my stomach it kind of makes me feel sick. So bear with me here. All right. Well, so far on our poll as to whether we will or will still be in a recession by 2023 or at any point in 2023, and 4 of you say yes. Anyways, I'm thinking about this trade because somebody asked yesterday, well, it was a few days ago, but I answered it yesterday on TikTok about, what do you do about dark pools, right? And my answer was, well, if you're the informed trader, if you're doing informed trading, it doesn't really matter because you can predict those orders, regardless of which exchange they're going to go to. So it's really nice to see the order flow to confirm what's going on or to falsify a thesis, right? But you don't have to see that if you're informed, right? And somebody asked, oh, well, okay, but where is this informed trader? And I was, well, the ego on me wants to say, well, you're looking at him. But the reality is that being informed is really more of a state, right? We want to think of trading as the quest for the Holy Grail. That's the approach. That's the story that most people in their minds tell. Is I'm searching for the Holy Grail, and when I find it, all I have to do is just drink from the cup of everlasting profits, right? I think that is the wrong allegory. I think that you should really be thinking about it more of like nirvana, right? It's a state that you can achieve where you are in line with the markets and you understand what is going on. And it's a state that you can move in and out of, that you can get kicked out of because the market changes and you don't understand how the market changed, right? This is being informed. So, you know, to answer this person that was like, where's this informed trader? You know, I think that this one was a good situation where we could come in and we could say, well, okay, we weren't informed. Before the news, we weren't informed. When the news hit, we were informed. Now everybody got that piece of news, right? But what did we do? Because we're so informed, we know so many other things about the context and the way that the market has been trading and everything else. We're able to take that information and we end up becoming more informed than other people do because of with that piece of information, right? The amount of information that we get out of it is higher than other people because we're more informed in general, right? And that's what happened there, and it led to a good trade. And another thing is that we're more informed about what the volume should be, right? Like, I think a lot of people can come in and say, well, that number was way higher than expected, and that is probably going to put pressure on the Federal Reserve to continue raising interest rates 75 basis points, right? Lots of people can make that call. But can they make the call that, well, because of that, about 20,000 contracts are going to sell in the Treasuries, right? And now that we've got 20,000 contracts, it might be an okay idea to take some off, right? Because we're informed about the how much flow. We can be informed about not just what the future orders are, but what the magnitude of the future orders are going to be. That is a very valuable piece of information. That's a piece of information that we're always looking for. They were like, oh, but what do you do about it? Like, it's really hard to predict. How far is it going to go? Is it going to keep going all day, or is it going to pull back? And is this like a 4-tick winner or an 8-tick winner? And you take it off and then it keeps going. And what are you supposed to do about that? What are the rules that you can set about what it's going to do? Well, that's the answer, guys. If you know the magnitude of the orders that are going to be triggered, you can sort out how far it's going to go. And the way that I do that is I just watch cumulative delta, and when the cumulative delta gets to my target, I take my profit. Right? A very valuable piece of information. Get the Bloomberg terminal? I wish. Man. So over the past month or so, I've been spending a way too much time trying to search for better cash treasury market data, because I want to see what the on-the-run cash treasuries are doing. So let me put it this way, or let me talk about this. Wait, was there another thing? Oh, by the way, it's from Jacob from the Jigsaw. I remember you. Good deal. Welcome. Oh yes, and I thought somebody purchased the my indicator package, and I didn't activate them correctly, and I fixed that, and they're going good too. So the world is going well so far for us. Well, even though I do still feel a little like the beginning stages of passing out. Okay. I think I'll be okay. I think it's just food hitting. Excuse me. I think it's just food hitting my gut. Okay. So here's an interesting thing that I was thinking about yesterday. Okay. So I was talking to somebody and they kind of gave me an idea. Okay. So there's something called a basis trade. So a basis trade would be like probably best example would be like the ES. So in the ES, like right now we're at 38.86, but in all likelihood, I bet you one of you guys is going to have this data and you're going to tell me, but in all likelihood, the actual index is going to be a little bit lower, right? The actual index is going to be a little bit lower than the future is, because the future basically has to account for everything that's going to happen between now and the expiration. And there could be, for instance, like dividends, or over here in the Treasuries, coupons that could get paid out between now and then that kind of make the future worth different than what the spot is going to be when that happens, right? And so this is what we call a basis trade, where the future is worth more than the spot. And by the time expiration comes along, they will tend to converge, right? And so a basis trade is a really low risk, high probability trade, because you can, even though the basis may widen at points, before expiration, the tendency is going to be that it will converge, right? Now, how do I trade that basis though? How do I decide when I want to get in? I would assume that it would be something like, I would want to put the basis trade on earlier, but I actually suspect that it's actually something more like that. Here, let me just minimize this for a second. I actually suspect that it's something more like this, where the futures price will kind of go up like this, and then it will converge. So you get this trade like this, and then it converges, right? So you would want to get in here when the basis is the largest. If you get in here and it goes larger, that's okay. It's just you're going to take a little bit of heat. But in the end, it will have the tendency to converge going into the expiration. It doesn't always happen, but like 99% of the time it does. Okay. So I would want to, chart the basis out and see when it's the widest, when was the best time to come in and take the basis trade, right? Well, if you aren't getting data for the spot, you're only getting data for the future, then you can't do that, right? So if I wanted to do a basis trade in the Treasury, let's just say that I had a huge wad of cash that enabled me to be able to hold a Treasury, right, a 10-year, like a cash 10-year Treasury, $100,000 of it or whatever. I would still need the data. Where do I get the data from? And I keep looking and looking and looking and looking, and the only place that I find that kind of data at all is Quick Strike, and it's like something like $500 a month. It's pretty steep price per month. So it seems like that the data and tools that would be necessary for a retail trader to take a basis trade are not available. Okay. But here's the thought. Okay. So then you got this thing. Okay. Spot. Let me go, because we're going to be, Treasuries right now are declining, right, overall. So it's going to be future, spot. Okay. So they're both going down, but the Treasury goes down faster and they converge. Okay. This is basis, B1. Okay. I can trade this. I can't trade this, so I don't have enough money to trade the cash, right? What if there was another one over here and its basis was like this, right? Way bigger, right? B2. Okay. So what I could do is I could sell B2 and buy B1, right? And basically, since I can't be involved in the spot. I can just sell this future and buy this future, right? So in the treasuries right now, we've been flattening. And we did flatten over the news, although we're steepening back out as we kind of rebalance out, right? So I could wait, essentially. So if I want to do the knob, do I want to do the knob? Because if we're going down this way, the 10-year is like way lower than the other ones. So I want to sell the 10-year and I want to buy the 30. Okay. If that made sense. Let me explain that. So the yield curve right now, if we're looking at cap prices, is like the 30-year is high, the 10-year is low, and the 5-year is high, right? So essentially, oh, I had it backwards, huh? No. I have it. This is yield. We want to go the opposite. It's actually, this one is low, this one is high, one is low when we're talking about prices. So if I want to, you still got this spread going this way, but what I want to do is I want to sell this one and buy this one, right? Because the spread trade is you sell the front month. So do I want to do 5 and 10 or do I want to do 30 and 10? Well, because the 10 seems to be the one that's more out of kilter, that's the one that I want to sell. So it's probably better for me to do the 10 and the 30. And on the basis, if I can find a situation or a place where the basis in the 10-year is larger than the basis in the 30-year, then that would be an more optimal location for a potential spread trade in the knob spread, 10 and 30. Interesting thought, right? But we need that basis data and probably historical to do all of the historical math and everything to see how good of a trade that actually is. Are you looking for spot bills? In particular, well, so cheapest to deliver would be one, but the one that I'm really interested in is spot prices for on the run 5-year yield. Because basically what I want to do is I want to see what they're doing in the spot and use that to calculate the micro yields and use that to determine my best bid and best offer so that I can provide more liquidity. Oh, by the way, I still have that 5-year on, but I never. Yeah. Okay. Cool. When I looked over there and I saw that I still had my 5-year armed, and it kind of scared me a little bit, but I didn't take a trade. Reuters, how much is Reuters icon, by the way? That's that's almost as expensive as Bloomberg, isn't it? Because that's all a part of Refinitiv. Well, I can. Independent researcher. I can put it in a thing and see what they give me. See what happens. I found a couple of places where it seemed like maybe they could get data or like maybe I could get access to these markets. So there's a number. Oh, how do you get the bare bones version with delayed data? That's something that they provide, huh? I mean, if it was delayed by 10 minutes, that wouldn't be bad. Or if it was historical data. So that's probably the next thing that I need to look at is what can I get from historical data? Well, I think the first thing that I need to do is okay. So normally when I want to like look at a trade and everything, I just go and I back test it in NinjaTrader. I don't think, well, I guess I should try it, but I don't think that NinjaTrader works out their back tester with multiple instruments. I could be wrong. I should try that. I should really try that. I probably am wrong. I think maybe it actually probably could handle it. There might be all sorts of weird oddities with it. But there's just kind of all these problems with doing that kind of analysis. So I've kind of been thinking, well, maybe I need to export that data out into some other platform and just get like the raw data and do a bunch of analysis on it in Python or something like that. So I can do that. Okay. Yeah. Any data that you guys have, any source that you have that gives you more data about the actual cash treasuries, I'm interested in getting or looking at. So if you guys have that, you message it to me. I really, really appreciate it. It seems to me there is like 2 or 3 markets that trade cash treasuries, the largest being BrokerTech, but there's also one that's run by the NASDAQ now at this point. There's 3. What's the other one? The other one is called Market Web Direct, I think is what it is. Trade Web Direct or whatever. And then the other one is Market X something, or I forget. Anyways, but they're all like institutional platforms. So as far as I can tell, I can't get access to those. But do you see the whole thing it's actually a really interesting situation here, isn't it? There's an opportunity here. There is an opportunity retail traders don't get on spot cash treasury data. Ooh, what the heck? I think that was my computer there. I'm continue to suspect that my video card might be dying. And I just hope and pray that it can make it until September. It's only 9. I know, right? Well, like S&P 500 is just opening. So let's see where they go now. Well, if I had held on to my trade, I could have made, because I got out at basically 80. Okay. So I probably could have made another 20, 30 bucks. But if I had held all the way to now, I would probably be down 20 bucks. So I'm kind of starting to wonder if it's not time for well, I don't know if I would say a new computer or if it's just a new installation. I've had this computer for a long time though. I don't feel like my computer is slow, but relatively speaking, compared to what's available today, it is, because it's a 1700X, right? So there are substantially faster CPUs out there now. I need to switch to an NVMe SSD as my main drive on my computer. I'm running it on a SATA SSD, but it's such a pain to transfer everything over. Dude, the new like when you're going through PCI Express 3 or 4 or whatever, it makes a huge difference, yeah. Especially in NinjaTrader when it's starting up and everything. Like the startup is twice as fast with a good NVMe. Okay. Treasury's pushing down there. Back to our entry, we could get good to get long at 0.8 there. Nah. I'm just gonna sit on it. Anyways, what was I saying? Oh yeah, there's an opportunity here, right? Like the market for spot treasury stuff is moving electronic essentially. Before it wasn't necessarily electronic. A lot of it was like over the counter, okay? It's becoming more electronic. Retail traders don't really have access to it. There are some companies out there that are like providing like baskets of um, fixed income assets that you can buy. They make like a nice little basket, and then you can invest in those on these platforms. Um, but like this space seems to be uh, getting bigger. So there's an opportunity for us, and if we can find a place where we can kind of get that data that other people don't, then we have the opportunity to build up in the micros, and then we could, decrease the spread to where a spread trade makes more sense, or sorry, a yield curve spread trade makes more sense, and then we can take advantage of mean reversion behavior in the yield curve and spreads. So that is well established in the research that the yield curve is mean reverting. And like I said, especially if we can start getting the basis involved in there and everything, we might be able to discover some really technical trades that would have a really high probability. We wouldn't make a ton, but I think that it would be super fun. I think that there's a real opportunity there. I don't have the connections, right? Probably the opportunity is you have a connection with somebody at the CME and they help you get the data or whatever the deal is, right? I haven't found the right person yet. I even emailed like some people at the CME and they didn't the responses that I got. I was actually kind of interesting. I emailed Gibbs and asked him a question about how do you calculate the 5-year based on this over here, and he spent more time talking about the basis than that. It was like, I think it was kind of like a coded message that I mean, what you're doing is interesting and all, but it's probably better for you to look into trading the basis, which is interesting, isn't it? I have an NVMe on my second gaming only computer. Yeah, that's what I need, man. Would really like to. I guess I could put it where the chalkboard is, but would really like to get a second computer that could be just for editing. Could be for my wife and for editing and art stuff. And the whole desk would be set up for art and maybe even audio production. Although for audio production, it would be better to put it over there because the room is longer this way. Okay. Well, so S&P 500 since opening, not really going anywhere so far. I haven't seen a really big change in cumulative delta either. It's just kind of chopping here. So and when I look at the treasuries, I'm definitely getting that okay, they made their move down and now they're balancing out, and the whole might very well be at 25. Like I'm seeing the opportunity in the market diminish significantly here. I think that the S&P 500 is probably going to have to make a move, and it wouldn't surprise me if it's up and that they actually end up getting a little bit higher than the news price and then just chop the rest of the day. President Biden putting out a comment about the Japanese prime minister dying. Jim Iorio. I don't know how you say his name. He's a guy, and he was actually was on Ninja Trader's YouTube channel the other day talking about yields. Still can't believe people lost money on those NFT things. That seemed like a rock solid plan. Oh well. Really? Micro Treasury yield futures saw a record 1,640 active users in June, marking a 10th consecutive month of participation growth. It's no wonder. Just look at the change in the yield curve since launch. He's right, dude. Like, guys, we got to make a video about this. I'm not gonna. It won't be this week. I have to be next week. But like, there are huge opportunities in the yield curve here. We are like at the cutting edge of retail traders getting involved in the yield curve. And like there is huge opportunity here for it. And like nobody sees it. Everybody's just sleeping on it. Right? We need to we talk about it in, maybe I should make a channel just for that in the futures trading. I bet Alligator could help us with that a little bit because he's done a little bit of programming stuff. Now we'll just do it in the interest rates channel. There's not that. It doesn't have to be super secret. Trying to find optimal, because there's definitely this thing to like, I mean, just look at it today. Okay, like here's the knob spread over here on the far left. Right? Oh, that one's delta. So 30-year delta is much higher, but you get the initial move down and then the whole rest of the way. I mean, of course, that's what Treasuries did in general, but it's like there's a certain point at which the yield curve is just extremely likely to reverse. We need to do more stats on it. I need to go through minute by minute data over several years. And I shouldn't do it with the treasuries. I mean, I could go and do it in Ninja Trader with the treasuries, but that wouldn't really help because you have to figure out the basis difference between them all and all that nonsense, right? Just do it with yields. I can just do it with yields and that will be way simpler and it'll probably be cleaner data. And try to discover statistical aberrations, the statistical properties, the stylized facts surrounding the yield curve. Right? That's what it was. Yield curve, stylized behaviors. Yield curve. Oh, well, there's one about what sort of economic things make it move. Term premium models and some stylized facts. Oh, maybe there. I'm actually getting more stuff to read here than I thought I would. Okay. This paper examines the importance of various macroeconomic shocks in explaining the movement of the term structure of nominal bond yields in post-war U.S., as well as channels through which such macro shocks influence yield curve using a structural vector autoregressive model. The results show that the monetary policy and the aggregate supply shocks are important determinants of the nominal term structure. Moreover, the monetary policy innovations have a large but transitory effect on the nominal bond yields, primarily by changing the slope of the yield curve. Oh, interesting. And the aggregate supply shocks from private sector have a more persistent effect on the level of the yield curve, but have little effect on the slope of the yield curve. Ah, interesting. Oh no, wait, why would it be? Okay, we'll read that later. We'll keep that one. Secrets of the yield curve revealed. No, this is just the same bullshit that everybody knows. Okay. We introduce a novel non-parametric bootstrap for assets with finite maturity structure, such as the nominal yield curve. We analyze the properties of our resampling procedure for interference on bond return predictability. Our method is asymptotically valid and robust to general forms of time and cross-sectional dependence. Moreover, it exhibits excellent finite series properties. We demonstrate the applicability of the results into empirical exercises. First, we show that a proxy for equity market risk tail predicts bond returns beyond yield curve factor. Second, we provide a bootstrap, bias correction, and confidence intervals for yield-based probability recession models. Okay, so that would be interesting if we were doing an economic model, but not for trading. This one is more about the term premia. There's something from the ECB. From the European ECB, as part of its forward-looking strategy, needs high-quality financial market statistical indicators as a means to facilitate evidence-based and sound decision-making. Such indicators include timely market intelligence and information to gauge investors' expectations and reaction functions with regard to policy decisions. The main use of yield curve estimations from an ECB monetary policy perspective is to obtain a proper empirical representation of the term structure of interest rates for the euro area, which can be interpreted in terms of market expectations of monetary policy, economic activity, and inflation expectations. Yield curves therefore play a pivotal role in monitoring of the term structure of interest rates in the euro area. Yeah, that one, I don't know if that one really helps us. Ooh, agent-based model generating stylized facts of fixed income. That's my stuff. We develop an agent-based model of a financial market with multiple assets belonging either to the fixed income or equity asset classes. Should reset my DOM here because we have moved back into the 25 range. Looks like there's still opportunity, like to get like 10 and 20 tickers, but it's kind of difficult trades, I must say. They kind of headed down. Like, you think that they could end up making a lower today? I think I'd say it's possible, but not as likely. The aim is to reproduce stylized facts of fixed income markets with regards to the emerging dynamics of the yield curve. Our ABM is rooted in the market model of Kaizoji, formulated with two types of traders: the rational and risk-averse fundamentalist investors, and the noise traders who invest under the influence of social imitation and price momentum. The investors involved in the present market model diversify their investments between a preferred stock equivalent and a perpetual bond and multiple bonds of selected maturities. Among those, a zero coupon bond provides a constant rate of return, while the prices of coupon-paying bonds are determined at each step by the equilibrium between the investors' demands and supplies. As a result, the ABM creates an evolving yield curve determined by the aggregate impact of the trader's investments. In agreement with real markets, it also produces transient turbulent periods in the prices time series, as well as a humped term structure of volatility. We compare the dynamics arising from different processes governing the risk-free rate with those of historical U.S. Treasury market, introducing Vasiak's model of interest rates to both synthetic and empirical rates. Demonstrates the capacity of our ABM. Oh, that's really interesting, but not what I'm actually looking for. So there's this whole thing about the yield curve. It tends to have a hump at the 10-year, right? And there's always been the question, well, why like that? Why isn't it just like a really gentle curve? And these guys are saying, well, and one of the theories has always been that it's like liquidity demand constraints, right? And these guys are that certain players in the market prefer certain parts of the term structure. And these guys, they went and they did an agent-based model. And when this is basically where you create a bunch of different players and they all have these rules, and then that plays out and you see what happens. And they're basically saying when these guys trade their optimal strategy, it creates this hump. So that is in support of the theory that it is the liquidity demands that creates the hump in the yield curve. And that is something that we could potentially use to our advantage in trading, but I'm not too sure. That's where you do again, remember I was saying that it's like this right now. If I'm looking at prices, this one's high and these ones are low. So what you can do, I was saying, well, you just want to do a knob like this, right? But if you really wanted to be neutral, you could also do this and buy the 5. So you could buy 5 and the 30 and sell the 10 in the expectation that the hump comes out. But the problem is that hump is always kind of there. So there's probably some statistics where when the hump gets so high, it's really likely to come back down, right? In other words, you could use a Bollinger Bands on it, right? Well, anyways. Oh, you know what? I had these stories up to see what Zero Hedge was saying about the news. Release the hawks. All that hope for an imminent recession and subsequent easing in QE is dashed by a better than expected payrolls print. They misspelled that. And stocks and bonds are being pummeled for it. Treasury yields are soaring across the curve, and what ultimately matters, Fed rate expectations are spiking. Today's print gives Powell and his rooms all the room they need to make a 75 basis point hike in July. With even Permitteville economists conceding that the U.S. economy is slowing rapidly, and today's payrolls report should be a big slowdown. Moments ago, the BLS confirmed yet again that the monthly payrolls number is nothing but a politically mandated homework assignment. So they think that the numbers are nonsense. When at a time when U.S. GDP is set to decline for 2 quarters in a row, reported that in June, U.S. payrolls rose by 372, but smashing expectations at 268K increase, well above the whisper number of 245 and trouncing Goldman's preferred payrolls range of 175 to 250. Yes, indeed. The change in total non-farm payroll employment for April was revised down from 436 to 368, and the change for May was revised down by 6,000. With these revisions, employment in April and May combined is $74,000 lower than previously reported. The June payrolls number was not only the third consecutive beat to expectation, but the biggest beat going back to February. As a reminder, this is what Goldman said coming into today's report. The market wants not too hot, not too cold to keep this bid. Strong enough to say the world isn't going into a recession. Not too strong to send U.S. 10 years back to 3.25% on the day. Not too cold to highlight U.S. data deteriorating while inflation will stay high and the Fed hiking 75 basis points into a dramatic slowdown, something like 175,000 to 250,000. What is even more confounding is that according to big data watched by Goldman, today's print should have been a negative 1 million drop. Yeah, so this number is like really far off of what their numbers were all saying. And while this was still the slowest number going back to April 2021, the pace of slowing is nowhere near enough for the Fed to be satisfied that the economy is cooling fast enough, which means an economy crushing 75 basis point rate hike in July is squarely in the Fed sights. I don't know if that's an economy crushing, but it is. It's going to hurt the equities. Going back to the report, the unemployment rate came as expected at 3.6 and unchanged from last month, with black unemployment dropping to pre-COVID levels, Hispanic unemployment slightly higher up, and nationally flat. Yeah, so it kind of seems to me that like some people did get kicked out of the market and that they just found new jobs really easily, right? Even more amazing and improbable is that the underemployment rate printed 6.7%, the lowest on record. Ooh, really? Meanwhile, the labor force participation rate dipped more than expected, dropping to 62.2% from 62.3 and below the expected increase to 62.4. Okay. On the wage front, average hourly earnings for all employees on private non-farm payrolls rose by 10 cents or 0.3%, in line with expectations and down from spot for last month. Over the last 12 months, average hourly earnings have increased by 5.1%, slightly higher than the 5% expected. I mean, that's good, but good for inflation, but not good for workers necessarily because they're down 5%, right? Should be up 10, 15. Average work week for all employees on private non-farm payrolls held at 34.5 hours in June and came in below expectations of 34.6, which, however, would have been a flat print versus last month, which was also revised lower to 34.5. In manufacturing, the average work week for all employees was little changed at 40.3, and overtime fell by 0.1 to 3.2. Blah, blah, blah. Average work week for production and non-supervisory employees on private and non-farm payrolls remained at 34 hours. So, just highlighting how big of a surprise this number was. And it's kind of funny to watch. Like you watched, market's not efficient. I think 3.25. Yeah. I mean, they threw in that zero hedge article, they threw out 3.25. I think 3.5 would be not crazy, but let's look for 3.25 first. But it doesn't look like they have the juice to get there today. Not on a Friday, but come Monday, we might have a really easy swing, right? Okay, Nick Timmeros, the Fed Whisperer, says the June jobs report keeps the Fed on track to raise rates by another 75 basis points in July. Yeah, I'm going to bet that July 75 basis point increase probability is going to go to like 99% now. When is that, by the way? When is the July meeting? It is July, right? It is on the 27th. So 3 weeks from now. 3 weeks from now. Looks like we did get a good little decline there, and they're now heading back up again in the Treasuries. Well, there's quite a volatile and random range throughout here that we've developed, but there's still a pretty clear node at 117.25. Fear of missing out, Wall Street and retail, hang on. The most significant risk to investors is when the fear of missing out changes to the fear of being in. Yeah. Looks like treasuries are lagging NQ. Well, that could be. There is a little bit of correlation here. overall it's difficult. Gold and silver haven't moved much on the day. That's kind of curious. No, it's kind of hard to say. I think that there's pretty good argument to say that most of these assets are just moving on their own, and that the treasuries in particular are just being driven by noise now at this point. But you did see an attempt by the S&P 500 to get back to unchanged, and then they got sliced down. They got cut down. Oil went on a little bit of a run up to $105 and then pulled all the way back to 103. So oil is moving. Yeah, forget gold and silver. Yeah, it is. You don't think it's interesting that gold and silver just didn't move on that at all? I was kind of worried that like gold and silver would just get trounced again, but whatever. Gold and silver is when you want to exchange your rotten tomatoes for less sour milk. It's a speculative asset that people don't seem to be that interested in right now, is it? Close all those tabs. Really? And there's lots of video about the assassination of Abe, and some people are... when they're chaos. Yeah, I think at this point, there was a lot of speculation that, because after 2008, gold saw a crazy run. I remember silver getting to $50, right? And then it kind of sputtered out. So after the pandemic, I think it was reasonable for people to think that you could see something happen in gold again, right? But it clearly isn't happening. I think that at this point, it's pretty safe to say that it didn't happen. You mentioned cumulative delta a few times. How do you use this? Can you share an example? Well, okay, so let's talk about what it is, right? So right now here in the 10-year treasury, we are bid 26, offered 26.5. Okay. Now, when you get data in, everybody thinks that you get a piece of data that says, okay, there was a trade and it was a buy and it was at 26, yada, 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 right? That's not how it works. All they do is they say volume and what price it happened at, right? So if we're bid 25.5, offer 26, okay, 26.5 right now, okay? And I see volume at 26. What does that mean? That means that it was a market sell, because the 26 is the current best bid. Okay, fair enough. Now, when the market is moving all over the place, those two feeds aren't completely in sync. You can kind of get some weird behavior, but in general, you can look at what the current best bid, best offer is, and what the incoming volume came in compared to those to determine whether an order was a market buy or a market sell. And then we can come in and we can look at that as a time series. So every time that there's a buy, you add to cumulative delta. Anytime there's a sell, we subtract from cumulative delta. So cumulative delta is basically a running total of all market orders. Okay. So the framework that we kind of work from is there are three kinds of traders in the markets. There are informed traders, there are market makers, and there are noise traders, right? We want to be the informed trader. We want to be the one that knows what is going to happen in the future and are trying to make a trade based off of it. And there's all these models about how many contracts if you know that at 9 o'clock, the 10-year Treasury will go to 118, then how many contracts can I buy? What's the optimal number of contracts to buy to make the most amount of money on that move to 118? Because if you trade too many contracts, the market will move against you and it'll go too far and yada, 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 right? So what's the optimal number of contracts, right? And then you, the informed trader, are going to use market orders to hit into the market maker, right? Who is putting limit orders out there, right? And the market maker is going to adjust his best bid, best offer based on the volume that's coming in to account for that informed trader, because the informed trader knows it's going to go to 118. The market maker can basically adjust things so that even if it goes to 118, market maker will still make money, right? Now, how are they able to do that? There's noise traders. Noise traders lose, right? And the profits basically come at the expense of, well, you have to have the noise traders in order for the informed trader to be able to execute without everybody seeing it and noticing, right? And the market maker needs the noise in order to do his work and not get destroyed by the informed trader, right? Okay, so when we look at it from that framework, right, we're going to just make an assumption. I know that's a really huge assumption that is not accurate to the real world, but generally speaking, informed trader uses market orders. Market maker uses limit orders, okay? So when we come in and we look at cumulative delta, what we're really looking at is we're looking at a record of what the informed and noise traders are doing with market orders, right? So if we have a piece of information, market is having a trend in a certain direction, right? We should be able to come up with some sort of estimate about how many contracts those people are going to trade. Now, it could be based on what price we think they're going to get to, but it could also be based on how many players out there will have to make a move based on this, right? Because they were the wrong direction, and there's speculators, and then there's large institutions that have to do stuff, right? Like they have to trade a certain number of contracts, right? And we can look at the piece of news and how big of a beat it was and everything to make a prediction about how far it's going to go in cumulative delta, right? In other words, you as a trader, you usually come in and you say, okay, I'm going to sell 28.5, and usually I will make 8 ticks, right? And then I'll take my profit and my stop will be right here, right? And I'm saying, what if you did the exact same thing, but instead of saying price, you say orders. I'm going to take my profits when cumulative delta has moved 20,000 contracts, and I'm going to exit if cumulative delta has gone against me 20,000 contracts or whatever the deal is, right? Okay, because what matters? It's the orders that matter, right? If we know how many orders are going to come in, that's a really good way to estimate how far it's actually going to go, right? So, like today, come in, we took a trade in the 10-year, somewhere around, we were somewhere around here, right? And then we had basically this happened right here, right? So that's what I took. And what I saw was 20,000 contracts, which was kind of in line with how far I would expect it to go before they'd have to pull back, right? And then some pushback that kind of suggests to me that the trade is over just because of the cumulative delta, right? So I'm not using cumulative delta to say, oh, okay, this right here, this is the way that a technical analysis trader would approach it, right? Technical analysis trader would say, okay, there's a lower low, but we didn't make a lower low in cumulative delta. That's a divergence. So I want to buy this here, and then I would have made X money or what? No, it's technical analysis. It doesn't work. Okay. But what we can do is we can use the order flow view of markets. We can predict the number of orders, and when we get the number of orders, then we take our profits. And that tends to be a pretty good indication about where is an optimal entry and exit. So that's how I use cumulative delta. I'm primarily interested in the running tally that I get from it, about how many participants have actually gotten involved in the market. Makes sense? And today, I wouldn't say that my exit was optimal, but it was okay. It was okay. It wasn't optimal, but it was okay. The air conditioning is turned on and it feels super nice. Ed's Brainerd, crypto platforms are highly vulnerable to deleveraging and fire sales. Nick Timmerell's quoting Brainerd here. It's important that the foundations for sound regulation of the crypto financial system be established now before the crypto ecosystem becomes so large or interconnected that it might pose risks to the stability of the broader financial system. Yes, it needs to be done now. I agree too. The problem is just that doing that's probably going to kill it. You don't have to worry about it. Eventually, stock market 401k will eventually go up no matter what. I'm not so sure, NASDAQ killer. Okay, so here's my scenario, right? Here's the thing that we got to keep in mind, right? S&P 500 always goes up. Why is that? Well, turns out that what you do is you go and you find all of the best stocks that performed that year and you put them in your index, and all of the stocks that were in your index that don't perform very well, you take them out, right? And that's how you keep always having like the nicest companies, right? Okay. What happens if we go into a world where all large companies start doing poorly, for instance? Maybe so one of the things that I see, there's this person on my TikTok that is obsessed with, everything would just be better if there was a more progressive tax system on corporations, because the higher taxes forces the corporations to compete more with the lower people. I'm not so sure that it's quite so simple, but anytime that you get this like, this is like the one thing that like solves all of our problems in economics, is usually bullshit. Okay, especially if it involves giving politicians more money. Okay, but let's just say, for instance, that they go and they do his plan. Okay, now all extremely large corporations are overtaxed and are going to do poorly. Your index is not going to do so well, is it? Right, because any large company that you're going to put in there is doing poorly. Could go on for a long time. I can see the case for there being an index fund bubble that pops and does a lot of harm at some point. It's possible. I'm not saying, I don't think, some people think that it's like an inevitability. I don't think that that's the case. I think that there's like a certain situation that we could come into, though, where index funds could really struggle, right? And we may be seeing it, actually. We may see a situation where the S&P 500 for 10 years is basically flat, right? Like if we take the bear market scenario, man, There's so many millennials because they remember what happened in 2008 and everything. They're just waiting for the collapse to happen, and they're all ready to just put all their money in there that they can to take advantage of the drop and everything. But I think that the reality is probably not so rosy. I think that if we really do have the Fed is tightening into a recession and we get a full-blown recession, it might not necessarily have to be a really deep recession or a really long recession. Like I said, we had it and we're already out of it, right? But the problem is that then everybody assumes that after that, we just go straight back up to all-time highs like we always have because they turn the money printers on and all of that, right? No, probably not. Because the forces that are creating inflation are likely to remain persistent, at least in the next, I'm going to say 5 years, maybe even 10 years. Okay. And that sets us up for a situation where even if we get out of a recession, you might not actually see very strong gains in the index funds, right? You might get a lost decade. You might get a decade where the index funds just kind of go sideways, whereas a value portfolio does really, really well and continues to return 7% per year, right? That's possible. It's very possible. Problem is that what the Fed is intending to do is not working. I disagree very strongly about that. So there's this sentiment out there. Well, there's two kinds of things. One is just like, oh, the Fed doesn't know what it's doing. Nothing that they ever do works. And there's this other group of people that just fundamentally don't believe that the problem is the market overheating and anything. They think that we can put money into the economy, and if that money makes the economy overheat so that demand overcomes supply, then we can just use the money that we're putting in to increase supply too. And we can just pump money into it forever, right? These are like the modern monetary theory people, okay? No. Doesn't work that way. And the problem is that the Federal Reserve here is not trying to make prices come back down. They're not trying to put people out of work. What they're trying to do is they're trying to prevent a wage price spiral. Okay, so we haven't had a wage price spiral yet. So I'd say that it's working. But if the Federal Reserve raises interest rates really, really hard and we still get a wage price spiral, then you could be right. Right? But it looks to me like the Federal Reserve is going to increase rates aggressively enough to prevent a wage price inflationary spiral from happening. And that is their primary goal here. There are a lot of people, so basically what they're worried about is there's inflation. So everybody demands that they get paid more at their job. Because everybody's getting paid more at their job, they can afford to pay more for groceries. So companies increase prices again. And then they go back to their employers and they say, well, we're still getting inflation, so you need to give me more money. And so this just keeps going and going and going until everybody inflation just goes crazy and you get hyperinflation and stuff. Okay. That's the thing they're worried about. Okay. So we come in, we reduce interest rates, we kind of get the labor market back into a reasonable spot so that people aren't requesting these huge raises all over the place, and that results in the prices of everything going up and all of this, right? They just, everything cools off, right? So you got to understand, it's kind of a really strange political rule of thumb, but generally speaking, Republicans prefer higher interest rates and Democrats prefer lower interest rates, right? And what has happened is we've been in a period where it made sense to have low interest rates for a really, really long time. And now that we're moving away from it, Democrats are doing everything that they can to kind of try and keep it. And you can even see that in individual economies, right? Democrats' policies tend to create inflation. And that's why expenses in blue states are much higher than they are in red states. No, it's not superfluous in an energy crisis. So, like, here's the thing: is you've got supply and demand, right? So we have a certain amount of supply and we have a certain amount of demand, right? And what has happened is that the demand is way higher than what the supply is. So it's going to have to, price is going to have to go up, right? Okay. So if you can't do anything about supply, what can you do to prevent prices from going up? You can tamp down demand. That's what they're doing. They reduce the amount of leverage in the economy, essentially, right? Companies can't go out and take on insane amounts of debt to go and start some huge new business or whatever the deal is, right? Okay. And the reality is that we've been doing things for the last 10 years where people have been able to take out debt that they shouldn't be able to, right? So it does work. It does work. Yeah, you're not going to change the supply through Federal Reserve policy. That's true. So what do you have to do? You have to tamp down the demand. It is, but and I know that's awful. It's not a good thing. It's not good for the economy. Well, not good for the average person. No, it's not. But it's better than the alternative, because what's the alternative? The alternative is the wage price spiral, and then you get hyperinflation, and then like society collapses. So you don't want that one, right? I see Amazon having their own freight services. Probably, well, they're already moving that way, aren't they, Jacob? Like they have the whole, like the Amazon blimp and the drones that like deliver packages and stuff. They've got like a like they're like testing it right now. It's crazy stuff, right? The EU was on an energy crash path long before the Ukraine invasion. The mere fact that the US wants to follow this model is insane, and Jim says such an odd feeling when you see policymakers marching slowly towards an awful destination. Plenty of people know how this ends, and they are too proud to listen. Yeah, they do. You know what's something that is a really interesting conundrum? So again, I'm really interested in how do you set up systems that will benefit people for hundreds of years to come? How do we ensure that our descendants, 10 generations from now, have a better life than we do? And what are the best systems to serve them on the really super high? This is, in my opinion, the highest level of thinking for good that we can do is to try and think about the systems on this really long-term path to be the best for humanity, right? And I've been arguing, well, I think the generational wealth is a part of it, because being, raising children with an understanding of these things is a really important part. And then they understand it, they can go and they can create jobs for other people, and that provides opportunities for them to also generate generational wealth, right? I also think that storytelling is a part of it, which is like, how do we more effectively pass down the lessons that we have learned to people so that they understand them and they don't make the same mistakes, right? This is, how do we teach history, essentially, right? Well, something that seems to be a very large barrier towards our goals here is that sometimes society will have an idea about what the distant future is going to be, and maybe at the time there was a substantial amount of evidence or at least our naive understanding of it did make sense for us to believe that thing was going to happen or was going to be a problem or whatever the deal was. But then things change. We learn more, right? And now that thing is no longer a problem. All right. So, um, what was the comment that kind of got me started on that? They're taking over gotten Amazon with 50%. Oh, geez. I think that somebody deleted a comment. Anyways, so we will run into these situations when a generation has an idea in their head like that. It's really hard to dispel it. It's really crazy hard to dispel. So the one that we are experiencing right now is that baby boomers were told that there's too many of them. Basically, their whole lives they were dealing with things being too crowded because all of the baby boomers all wanted to do the same thing. And that generation was so much larger than what people had previously anticipated that, there wasn't enough for everybody. And the baby boomers have been dealing with that their whole life, right? So they've always had it in their heads since the 70s that the world is overpopulated, we don't have enough resources for it, and that we all need to stop having kids, right? And they taught that to their kids. They went and they had kids and they taught that to their kids. So now we have like 3 generations of people that all have this idea in their head that the world is overpopulated, and it is empirically BS. It is not a thing at all. Our ability to produce resources, we could handle a population like double the size of the current population on the planet. Okay, the planet can sustain that. Okay, like we have the technology to sustain that today. It's just not the logistics, right? It's people in third world countries that are having problems and stuff that are preventing us from being able to support that number of people, right? And the population isn't growing anymore. By the end of this century, population growth will basically be negative. And based on current trends, we are living in a time when the most number of people will be on the planet that ever will be. Ever after that, it'll be less people on the planet, according to current trends in the statistics, right? And this presents real challenges. We're already familiar with the deflationary effects from aging populations, right? Japan's definitely felt that, right? But you're also going to start to run into like supply chain constraints too. You're going to run into situations where you want to build certain things, you want to do technology. We want to, I don't know, go to another planet. We won't have enough people to be able to build this stuff. It's like, well, we think we can build this stuff, but we can't because we don't have enough people. Right? Like that's going to be the challenge in the future based on the current stats. But because everybody's been told all their life that the planet is overpopulated, they don't listen. Right? And it's this the same thing with energy. Right? Policymakers marching slowly towards an awful destination because they've been told all their life we need to get rid of oil. So they're doing it, not understanding the economic consequences of trying to force it to happen and not being ready to replace that energy supply with clean energy sources, and being against nuclear power, the one power source that is actually capable of fulfilling our needs, right? And with nuclear power in particular, the general public has a view of nuclear power that is just so completely off from the science. They think it's so dangerous, and the reality is that it's not. It's safer than other forms of energy. How do we deal with that problem? I don't know. But I do think, I'm starting to think that getting good at storytelling is probably a major tool that we can use. So I when I think about my stream, I think I've been telling the wrong story, to be honest with you. I think that to me, my story is we're on a hero's journey. We're coming in, we're trying to do things. Sometimes we have setbacks, sometimes we do well, and it's always just an ongoing adventure that is really fun, right? But that's not what people actually want to hear when they're looking into these sorts of things, right? I think that they want to hear the what do we call it? Oh, sorry, from rags to riches story is what they want to hear, right? And there's certain like key markers that you're going to hear when you have rags to riches. I mean, I can tell that story. I guess I don't know. It's like not the way that I approach it, but I do probably should talk about it that way. Like, here's the thing. I remember coming out of school, man, and like our first apartment was like I don't remember how much it was. It was less than 500. I think it was less than 500 square feet. It was like there was a front room, there was a tiny kitchen that was basically like a hallway that was like just wide enough for the oven door to come down into, right? And then a bedroom that was just large enough for our bed. And that was it. And like my computer and the couch and the TV, and that was like the whole front room. Right? And I didn't just live there for a while. Actually, I was thinking back on it. I was like, I lived there for a long time. And then I moved to another place where we had 2 rooms. I lived there for a really long time too, man. That was not until like 28. So like 8 years, I think. I lived like that, right? And I ran into some real problems too. So one of the things that happened to me was my wife wanted to get in shape. She had some health problems. So she went and got like a membership at a gym and like prepaid for 2 years. And I let her, like, I agreed to it and everything, but then it was a lot of money. It was a lot of money, man. Like, it was a ton of money we could have done with other stuff with. And then she like had a back problem and didn't really ever get to use it. So it was all wasted, right? Another one that happened to me was I put all of this effort into, maybe getting a real estate license. So maybe I could do that on the side. And as I was getting that real estate license was when the housing market started to collapse. Like, they were talking about it at school, and it was like, oh, well, I don't want to. I mean, I didn't know that the whole 2008 thing was going to happen, but they were basically warning us about it. And I was like, oh, I don't know if I want to get into this industry right now. So I put all that money or all that time going to the classes for 2 weeks, which was really effing hard, by the way. And I didn't even take the test or use it because like the market was terrible for it. Probably should have still done that, but it was hard, right? And then I learned about markets and interest rates because the 2008 crisis happened. I knew politics. So I said, well, I need to learn the economics here because that apparently is going to be a really important thing, right? I get why, finance, I know to you guys, finance is not boring, but to many regular people, finance is boring. And interest rates is definitely boring to people, right? Interest rates are the most boring things. They don't move super crazy. They're really actually quite reliable and predictable on a relative basis because you can calculate everything out about what they're supposed to be worth and everything. They're not interesting to people, but that's not what I found. And me learning that interest rates are actually interesting was everything. I probably could be making okay money as a game developer, but I probably would hate that. They'd probably be overworked, probably wouldn't be making as much. And all of the good decisions that I've been able to make since then financially came as a result of me understanding the interest rate market. Like, I knew that this whole housing thing was happening and was a problem in the future. And I said, I need to save up as much as I can and get into a house immediately. And I did that, and I got into a house. Oh, it's been now, I think I've had houses now for 8 years now, I think. Right? I have wainscoting on the walls. Okay. I don't like bragging, but I have wainscoting on the walls here in my office, okay? It's a pretty nice house. It has rooms for 5 children. Okay. Actually, I could probably even do more than, and I could fit even more than that if I wanted to double bunk them. Okay. All of that. Wouldn't have it if I didn't understand interest rates. Just because I knew what the state of the market was, I knew that it was a good time to buy because of the interest rates and everything else. And I knew to put money away, so I have a good amount of money in retirement accounts, so I should be able to retire comfortably, because whereas most people won't, because I knew how much money I needed to put away, right? I'm telling you guys, there's so much value in understanding interest rates. Like, look, you can come in here and you can trade interest rates. Everybody has this idea you're going to become a millionaire, right? You're probably not going to become a millionaire from trading, okay? But what you're going to learn in this process is so incredibly valuable, guys. Would not be anything. I didn't understand this stuff. Maybe I would have figured something else out, but it's valuable stuff. And coming in and just risking a few $10 a day on the treasuries as a holiday, yeah, you're not going to become rich from it. Probably not. But what you're going to do is you're going to use that information that you're learning, and you're going to use it in your day job. You're going to use it to get a better job. You're going to use it to know what industries to go into and how to react to the current economy. It's going to pay so much more. It's going to pay so much more in the long run. Right? That's the story. The ranks, it is true. Because of interest rates, it was kind of a rag surges, and the stream too, frankly, because I didn't know nearly as much as I thought I did when I started this stream, and the only reason that this really got going was because of a contest, and then y'all started watching it, and it just kind of was a lucky thing that happened to me, and the channel has become remarkably successful. I think that there's this tendency to come in and say, like, well, you have a big channel and you do okay trading, but maybe you don't actually deserve it because you didn't become a millionaire or a billionaire from trading. But it's not true at all. I have come from basically out of nowhere and developed quite a following from nothing, and for good reason, because we're providing real value here. Things that people really need to understand. I think that so many people think that it's like, well, you need to know that you have to put money in your 401k and stuff. Like, man, I mean, that's basic stuff. That's basic stuff. If you don't understand that stuff, like, you're just not reading the papers that they give to you at work and stuff, right? Read that stuff. But to really make the changes that are like really going to give you an advantage in this world and help you build generational wealth, you got to understand more than that. And that's the sort of stuff that we're providing here. Real estate brokerage is the number one career for a retiree. Is it really? Is it really? I love the fixed income markets, though. There is so much more than treasuries, euro dollar spreads, Eurozone bills, swaps. You're totally right, Jacob. That's why I was saying, like, I really think that we have an opportunity, because those markets traditionally were not very electronic, and they're becoming more electronic, and they're going to come to retail traders in many ways. And I'm sure that I think the next thing that we're going to see is that the CME will probably make like mortgage rate futures, probably. And they would get all sorts of other things. Yeah, I think there's going to be opportunities for us in the future. And I think that right now, people think that, oh yeah, bonds are boring. But 10 years from now, they're going to say, oh man, I really wish that I had learned more about the interest rate market 10 years ago, because there were so many opportunities that came along that I wasn't able to take advantage of because I didn't understand enough about it yet. I really think that's what's going to happen. And like, all of the retail traders are sleeping on it. All the retail traders are noise trading in ES still and learning nothing about the markets. They know tons of stuff about, now I'm kind of getting on the rant, right? Now I'm kind of getting maybe a little egoistic about it, but But come on, man. There's all of these retail traders out there. They know everything about moving averages and candlestick patterns and all of these sorts of things. And they're not learning jack squat about the actual market, the things that actually matter and are actually going to help them. And it's insane. It's crazy. They're all just sleeping on the Treasury market. They're wasting their time on noise. When I see this chart, man, noise. Okay, this thing right here, that was a real move based on news. This move higher, or I mean, like its tendency to move higher, like I said, like there's some seasonality and stuff involved in it. All this stuff here in the middle, it's noise. And anybody that thinks that they can predict what's going to happen in here with a high degree of accuracy, prove it. Like seriously, you just come in, show me something over a 5-year time period, 10,000 trades, and it has a probability higher than 55%. If you do that, I will give you $1 million. Literally, I know I'm making a promise that's like hard to fulfill because I don't have $1 million right now. What I'm going to do is you have to tell me the strategy too. You give me I'll buy the strategy from you for $1 million. What I'm going to do is I'm going to take that strategy, I'm going to start a fund, and I'm going to start, managing money with it. If you had something like that, okay, like seriously. But I really don't think it exists. I think that most of what happens here in the S&P 500 is noise. And there's just certain time periods where, because of the news or, other kinds of catalysts, where you can generally predict where it's going to go. It's a lot easier to do it over here in the Treasury, though. It's a lot easier to say, oh yeah, we need to sell this. Now I get out because they're just rebalancing. It seems so simple. Why do we make it so complicated? But it's because we don't want to. It's because we don't want to do the actual work. We don't want to learn the boring stuff about what interest rates are. But I'm telling you, man, it's way more exciting than it appears on the surface. It's way more exciting. Listen, think about this. How many people do you know you've been watching online? They talk about interest rates, right? How many people do you know that they're in the interest rate markets and they're like, yeah, it's boring, I hate it, and spend all their time, I wish I could trade the E-mini, but doesn't. I mean, that was me for time until I kind of realized that it wasn't. But like, you don't really meet a whole lot of milk toast interest rate traders, do you? They're always really passionate about it. There's a reason for that, man. Is once you get into it, it is actually really exciting. It's way more exciting than it seems under the surface. Trading view quotes on bonds are real. Those are quirks to it. Spent the last 2 days figuring out whether it was real or I was getting punked. So let's go back to that. Yep, fixed income markets move equities. And the fixed income markets, if you understand the fixed income markets, you're going to understand all of the other markets, right? So it's a good place to learn. Okay, so what was the it was like US 10Y, government bonds yield, TVC, and can I come in and get 1 minute data on it? So it is saying that the 10-year. So here's what I'm interested in. Is it says that the 10-year is at 3.063 and the current on the run yield in the micro treasuries is 3.085. Okay. So this is 08 and this is let's call this 7 in 08. So there is basically a basis difference of 1 basis point. Right? No, I understand you can remove the Y. I'm just using the 10-year to kind of you kind of maybe missed this. Oh, by the way, actually, I was talking to somebody yesterday. Well, I was talking to Discovery Trading. Are you familiar with them? I think it's so. What is his name? I get his name exact. Twitter.com. He was messaging me on Twitter. Yeah, Discovery Trader on Twitter, and they were looking for a spread trader to do a directed strategy. I don't think that it was very good for me because I got other stuff going on and everything. But I was like, well, actually, it kind of does that. So it would be worth messaging him if you're into that. It was saying like you'd still be able to trade your account and everything, but you need somebody that understands the spreads enough to execute it for them or something. It was you should you should reach out to him if you're interested in that. But anyways, he's when I was talking to him, he kind of gave me an idea because he was saying, well, all like yield trading is kind of like a basis trade in the end. So I was thinking about it and I was like, well, okay, so can you actually do a basis trade with micro yields? Is there a basis difference with micro yields like there is with everything else? Even though it's like only a month-long thing and all this other stuff. Oh yeah, I know you're not looking for a job. That's what I was saying. Like you'd still be able to trade your account on the side and everything. But I don't know. I wanted to help him, and you were probably the best person that I could think of for the job because, like, the reality is that you don't meet many people talking about spreads and stuff. And I really want to get more into spreads. Oh, anyways, let me try and paint out the scenario that I was thinking about here. Was that what he was saying? That's all basis trading. So right, so like if this is 0.7 and this is 0.86, there's like a 1.5% basis, or sorry, it's going to be an 0.15 difference in yields, right? Basis difference. So a basis trade typically would be I sell the future over here, 3.09, and I buy the cash, and they will converge into expiration, and then I will make that basis point. Essentially, I make $15 or whatever it is, right? Except for that you come in and you like leverage it up really, really big so that actually you make $1,000 or something, right? Or $10,000 maybe if you have enough leverage. You have a big enough wad of cash, right? And the thing is that yes, this could go up, but you're kind of hedged. And the thing that you're trading, the thing that you are exposed to is the basis. So if the basis changes, so if all of a sudden this is worth still 3.073, but this is worth 3.1, then I'm losing money, right? Then I'm losing money because the basis got bigger. But that can happen. And as you get closer into expiration, the tendency is going to be for it to converge. It doesn't have to, but the vast majority of the time it does. And it's a very, very low risk, safe trade, right? Problem. Where do you sell spot yield? You can't do that, right? But then I was, and it's the same problem over here. It's like, oh, well, you could do a basis trade in treasuries, right? That would be great, but you'd have to have $100,000 to do it. You'd have to have access to the cash market, and then you could do it, and you could just deliver treasuries or whatever the deal is, right? But again, I have that, right? Okay, yep, that's the first quirk. The trading view quotes are dirty, i.e., they are with the accrued, but the micros are on clean price, so they will be a bit off. Okay, good. So, there is one source that I do know of that will give it to us clean, right? Oh, but they are OTR quotes. They're quote unquote dirty. Okay. So the one place that we do know of where we can get this information is when we come into the yield. There isn't this one. Yeah, here we are. These ones are based on like the fixing time for those indexes, right? So we could use those, but you'd have to look at, so like yesterday, the 10-year, this one it says it closed at 3.01, but on our chart here, what was it? 10 YR. It was 3.1. So, oh, no. It wasn't 3.1. It was 3.23. So, still about, it's close. So, it is still about 1.5 basis points. How do you get that? How did you get the TradeWeb quote, Jacob? Is that from the same Refinitiv thing? Because that's what I want, man. I want the trade. Like, I was searching yesterday, like, how do I get TradeWeb quotes? Couldn't figure it out. He says spot yield is 3.707. That would be, well, 3.074, let's say. 074, that's 2 basis points. You get it through Refinitiv. I want it. I need that. How did you get that, dude? How much do you pay for that? Is it like an arm and a leg to get? Like, if it was like $50 a month, then I think I could pay. I would pay it. But okay, 1.5 to 2 basis points. Cool. All right, but we can't actually do that trade. But then I was thinking, okay, but how do you even do the basis point trade, right? Well, if it tends to converge going into expiration, I would think that the simplest way of doing it, correct me if I'm wrong here, Akshay, this is kind of the question I want to ask you today. When do you put the basis point trade on? Because that's basically what you're doing with euro dollar, right? It's basically like a basis trade, right? When do you do it? The simplest way would be just get in at the very beginning, right? Checked and calculated the clean yield on every 15-minute candle yesterday. The clean yield on TV quotes was between the BA spread on the micro every single time on 30-year and 10-year, the only ones with volume. Clean yield on TV quotes was between the bid-ask spread on micro every single time. Gotcha. So we might be able to use the 5 for that. Well, yeah. No, yeah. Because the whole thing is we want to use that one. So what we're suggesting here is that we might be able to go to TradingView and say, oh, hopefully it has that one chart. Come in and say US 5Y. Oh, they don't have it. Doesn't help because they have the 10 and the 30, but they don't have the 2 and the 5. That's so funny. Oh, man. Okay, but anyways. Okay. We don't have much time. So focus, Seth. Okay. So the easy thing would be, if you're doing the basis trade, as soon as the new contract starts, put the basis trade on, right? And then just hold it the whole time. That would be the easy trade, right? But the reality is, as I understand it, is that it actually kind of starts like this, right? Like if we were to graph the actual basis, the difference between those two on a graph, it starts out, it actually goes higher, and then it kind of evens out like that. It's my understanding of it. Oh, US 05, not US 5. Okay, hold on. Okay, so you don't necessarily want to do it right away. You want to do it when the basis difference is like out of whack. So what you should be able to do is you should be able to say, like, look at this basis over time. Every time it's like this, right? And we can say, okay, this is like the, we could do it with a z-score to say this is when it's optimal to sell it in the basis, right? Okay. Now, we can't actually trade the actual basis, but it might give us a time to take an optimal trade in the spread, because we might be able to say the basis difference. So that let's go back to trading view. Okay. So US 05Y. Yes. Okay. So let's do 05Y and let's change the settings here to just be oh, actually not that one, to just be a line. Okay. And then we're going to add US 10Y. Same percentage scale. Oh, actually, I don't think I wanted that. I wanted oh, no, yeah, same percentage scale. Okay. And then I can add US 30Y. Same percentage scale. Okay. Settings, style. This one will be a line as well, but we'll do the 10 will be gold, and the 30 will be let's make it like reddish or something. No, purplish, pinkish. There we go. I don't think that the same percentage scale is the right way to do it, actually. Well, it doesn't matter. Oh, actually, it does matter. Let's start over. Let's just go with this one. Okay, the 05, so it says right now that it's 3.110. So they've got a bid that's way higher than that, right? But we should expect there to be a difference in the basis, right? So here they're saying that the basis difference is 2.5, essentially, right? 110, was it? 2.110 is way down here. So it is 2 basis points. Okay. So the difference over here is 2 basis points. And the difference here is 1.5 basis points. Right? Is what we just calculated. So then what if instead you tried to play the 2 basis points off of each other? Right? So what you do is you sell this one and you buy this one. Well, that would be a steepener. It would be against the yield. So I don't think you'd want to do that one. So now let's look at the other side of it. US 30Y. Okay. They're at 2.63. 2.8. So you're getting like 1.5 still. Okay. But you could still maybe do that to put a flattener on, right? Basically, if I can see a difference in a basis between the different maturities, and especially if I see an aberration in the basis difference, that could give us an optimal trade location for a spread trade. What do you think of my theory? Think that we need to go in and like do a bunch of backtesting and stuff? Sure, but is the half a basis point enough to cover the round trip costs? So if the yields are Well, so for here, for me, not counting data fees, I'm only paying 0.2 of a basis point. So I'm losing 30% of my profits from costs. So it would make it up. You could put leverage on. But since we're not trading the basis directly, there's still some significant risk on the yield curve in general, right? So the risks involved with the yield curve trade are probably more significant than anything that we get from the basis point difference. But it's not so much, maybe there's a situation where this one is 3 and this one is 1.5 and there's like 2 basis points that you can kind of pocket there. And then when you think about that one, because last time that I tried a spread, it was like, I think I lost 5 basis points on it in the end. So like if you have that 2.5 to kind of work with and you're in the right direction, that really adds up and makes the yield curve trade a lot more attractive at that point, right? So that's kind of what I'm thinking is like, okay, so what I need to do is I need to go and I need to get export stuff into Python to get all of the on the run yields on a minute by minute basis and over the difference over here and the basis difference between them. And then I can see, okay, so does the basis converge as we come into the end of the month? And then where is the optimal time? And then if I trade the spread at that optimal time, does that help? And then what are the mean reversion properties of the yield curve spread itself, right? Can I literally go in and look at it and be like, well, I can come over. Well, I don't have that chart open. I could go and look at a daily chart of it, and all of the spreads and say, okay, here's a Bollinger Bands, a really, really long moving average. And then when it gets above this Bollinger Band, I sell it or whatever the deal is, right? Is that the right way to do it for a spread trade? Basically looking for the mean reverting behavior. But we still have to know if it's generally we're in a flattening environment or a steepening environment. Which right now I think that we're definitely in a flattening environment, so we're probably okay on that one. But that can change. That's my thought. That's the thing that I think I need to work on right now. And I still would really like to try and figure out if I know what the 10-year is, what should the yield over here be? But I don't know. This is kind of interesting because what it seems to be saying to me is that this 5-year is actually too high. That the 5 and the 2 may actually be way too high. Yeah, you've never used the Bollinger Bands. Basically, what we're saying is when the when the knob spread, if we're charting the knob, when the knob spread gets too high relative to its long-term moving average, right? Essentially, we're looking for a statistical aberration which to reverse the move on the assumption that it's going to mean revert back to its long run trajectory. But actually, it did give us like a study that we can kind of use. But I don't think there's too many implementation details kind of left in the wind on that, right? Like they give you the general idea about how to trade the yield curve, but it's kind of like, okay, but what are the practicals about how you do it and when you do it and all of that sort of a thing that it doesn't really answer, that we're going to have to come in and do some data research ourselves with. It's going to be hard, but I guess if I got it there on TradingView and I just use that might be enough. But there might be some other places that have really reliable historical data. Like it sounds like Jacob has the historical data for me. So, well, anyways, it's time for me to go. Let's change the title. Give that a thought, actually, about how we want to, what we might investigate on that. And if you don't want to help discovery trading, maybe you know somebody that I don't, that you could send their way, because it sounds like they basically they know what the spread trade that they want to put on is. It's like a very directed strategy. They just need somebody to manage it, which is like, oh, Seth, why didn't you say that you can do it? But I've got other stuff going on. I don't think that I would be very good pick for that. Yeah, so just specifically about knob spread, it has a very high mean reversion in 6-month cycles. Okay. That is a good start. Okay. Non-farm payrolls. Upside surprise. Destroys treasuries. It was a day today. See, like when I start talking about the spreads and like I might actually have the discovery trader, like here, I just copy. This guy. By the way, after all the votes, you guys almost all unanimously think that we'll have a recession in 2023. That there will be at least 1 month where we are in a recession in 2023. Cool. Interesting. It was that high. Okay, guys. I will see you guys Monday. In the meantime, stay profitable, friends.